Connect with Nilesh Shah, Managing Director of Kotak AMC. And Kotak AMC has also launched their first Balanced Advantage Fund. Nilesh, good morning. Thank you for joining us. Our viewers are programmed to think in terms of mid and small cap stocks. But do you think it's high time a retail investor should also start thinking on the lines of balanced advantage, because the times they warrant a different kind of an approach? You always say this cricket analogy that you need to have a different style for every time you're playing on a different pitch. So has the pitch changed for an average investor?
Definitely, Nikunj bhai, pitch will be either bowling pitch, batting pitch, or a pitch which assists batting as well as bowling. You could be playing a T20, you could be playing one day, you could be playing test match. Your approach and technique will have to change in all of this, and which is where Kotak Balance Advantage Fund comes into play. In a betting pitch where market is very cheap, valuations are in your favor, will play like T20, hitting every ball for a 4 and a 6, investing in small and mid cap stocks. 80% of fund allocation will be towards equity. On the other hand, when markets are expensive, bull market is coming to an end, our strategy will be to play like test match, save the wicket and wait for half volley to come. The equity allocation will be around 20%, majority towards large cap, very few small and mid cap. When the market is fair value, range bound, neither going up or down in a particular directional manner, the fund might be between 40 to 50% in equity, majority towards large cap, but some mid cap and small cap. The idea is to play one day, keep the scoreboard running, ticking with 1 or 2 runs, and wait for half volley. So this is a fund which allocates on a quantitative basis based on valuation parameters and trends and sentiments between debt and equity. The fund will swing between 20% to 80% in equity allocation, looking at the valuation of the market. The fund will also allocate between large, mid and small cap, looking at the valuation differential between them. And this is assisted by quantitative models so that the personal emotions does not take over. The stock selection is left to the fund manager. Overall, this fund endeavors to deliver volatility which is significantly lower than a pure equity fund, and over a cycle from a bull market to bull market or a bear market to bear market, deliver return which is comparable to an equity fund.
But Nilesh, do you believe that this fund is more suited to the current times, or would you say that this is okay even for a long-term investor, because times they have changed and they've changed permanently? You've got to have your exposure to fixed income, and asset allocation and diversification should be the mantra to follow now.
This is an evergreen fund. This is suitable for all kinds of investors. If you want to do lump sum investment, this is appropriate. You want to do SIP, this is appropriate. You want to invest for the first time in mutual fund, this is appropriate. You want someone who times the market, this is appropriate. Anyone who has horizon less than one cycle of the market, from bull to bull market or bear to bear market, anyone other than that, this fund is appropriate for everyone.
Introducing this fund at this time, what's the rationale, given the fact that one is still expecting a bit of an upside for equities? Why are you recommending de-risking one's portfolio by having a balanced approach?
Essentially, in last 6 months, we have seen some of the investors who have taken out their money from small and mid cap stocks or small and mid cap funds. These are the kind of funds which reduces volatility on the way down and does not unnerve the customer compared to a normal equity fund. Second, many a times, when we have when we have advised people to come into equity mutual funds via systematic investment plan, there are many people who come back saying that, Nilesh bhai, we don't want to do SIP. Take my lump sum money and you manage according to your requirement, your wish. Now this is one fund where we can accept lump sum money. Throughout our career of last 25 years, we have always pushed SIP. Now is the time to push for lump sum from those investors who can give us one investment cycle horizon. So this product is suitable with a view to reduce volatility and yet aim to deliver as good return as a pure equity fund.
Nilesh, within equity and given the current market backdrop, what is the classification between large caps and small caps? And do you believe that maybe the small cap pain could be coming to an end while we're celebrating the Sensex and the Nifty already or almost close to the all-time high? Is it time now to shift more towards small caps? Is this the right time to start nibbling into those names? And therefore, would the equity category within this balanced fund be skewed a little more towards small caps, or does it have a more large cap bias?
So as of today, our models suggest around 35 to 40% allocation to equity, and within that majority to large cap. As per our model, the small caps and mid caps haven't become as attractive where we can put money from balance advantage fund into it. And mind you, this is a very conservative fund which aims to reduce volatility. From a fundamental point of view, within small and mid caps, we'll have to make two bifurcation. One, there are small micro mini cap stocks where governance is doubtful, balance sheet numbers are debatable, auditors come and go, where institutional participation is very limited, where valuations were taking into account more rosy future, then probably it was justified. I think for these stocks, maybe the bottom is not yet made. The selling interest has receded undoubtedly looking at the broad market. But these stocks, I don't think so, will bottom out at current level. On the other hand, there are many quality small and mid cap stocks where governance is not debatable. It's their balance sheet is reliable, the management is there for last few decades, and clearly those stocks which had fallen in line with the momentum stocks have started showing not only receding selling interest but also some amount of buying. And we have seen today also in terms of breadth of the market or some of the sectoral stocks going up by 2 to 5%. So that kind of trigger, whether it's because of result, whether it's because of lack of selling interest, because of some buying interest or other factors, those stocks, the quality small and mid caps, will start making a bottoming out process. But the momentum driven small and mid cap stocks, I think there is a room to go down further.
Interest rates are not likely to go down. Inflation is back. Does it make sense to align a portfolio which is skewed towards debt? Because the big returns or the great debt returns are actually behind us.
Nikunj, from a carry point of view, debt today provides a reasonably good opportunity. Yes, inflation has marginally inched up. From 4% it might become 5%, but today AAA rated FMP or a credit risk fund are giving almost 3 to 4% real rate of return over the inflation. More importantly, looking at the steadfastness with which RBI is controlling inflation, it will be fair to assume that going forward the trajectory of inflation will be more around RBI's target rate of 4% rather than higher. That means this 3 to 4% return is there for years to come, depending upon what kind of maturity of fixed income product you have taken in. Mind you that in equity real return of 3 to 4% is rarely possible. So today undoubtedly fixed income funds or fixed income instruments provide a very attractive real rate of return, and over a period of time as RBI's conquest of inflationary expectation comes through, my feeling is that market rates will also start declining over a period of time. This is not short term, near term prediction. It's hugely volatile and quite difficult to predict where rates are going. But if you take 3-year, 5-year view, and we believe inflation will be anchored around 4% where RBI is targeting, then there is no reason how 10-year yield could remain at 7.75 or 8%.
Right. Nilesh, just a very basic personal finance question. Do you think for average investor it is a good idea to have a blend of balance fund or have individual categorization or individual allocation to debt and equity? I mean, rather than buying a balance fund which is a blended play on both debt and equity, how about simply buying one equity scheme and one debt scheme?
Nikunj bhai, when you are buying one equity scheme and one debt scheme and you have to change allocations, you end up paying the transaction cost, which is exit load, or you end up paying capital gains tax in case you are making profit. Whereas when this thing is done in a pure balanced fund by the fund manager, then there is no transaction cost, there is no taxation cost. And that deferment of taxation cost and transaction cost can significantly increase your IRR. We did a one simple calculation, assuming that you are making 15% return in fund A versus fund B, and in fund A you kept on paying long-term capital gain at the end of every year. So first year return 15%, on 366 day you redeemed that fund, you paid 10% plus surcharge or whatever it is, and the net return in your hand is 13.5%. The IRR of that fund over 30 years remains 13.5%. But in the second fund you defer your tax by compounding and not booking your capital gain. So on the 30th year, your return is 15%, you pay 10% tax on it, assuming that the tax rates have remained constant, and your overall IRR, because you have deferred taxes, actually goes up to almost 14.6%. So you end up making 90 basis point extra because you deferred your taxation. So instead of having one equity fund and one debt fund, it's far better to have one balanced fund where fund manager does the allocation so that you don't pay taxation cost, you don't end up paying transaction cost.
All right, Nilesh, good luck, and good luck for your marketing of